Hey guys, Tim Melvin. Hey guys, Tim Melvin here, coming to you on a Wednesday afternoon. We'd hoped to be in earlier, but Monday and Tuesday got a little out of our control, let's say. Anyway, selling continues today. Guys, I'd love to tell you it's almost over. I can't. There's really no end in sight for this, okay? We're still trading at very elevated levels, no matter how you look at it. Price to earnings, price to earnings, price to 10-year earnings, price to cash flow, price to free cash flow, price to book, price to sales. We're still at very elevated levels. There's still hundreds of stocks, hundreds of companies with no profits. Kind of interesting stories, maybe even exciting, but price to sales ratios well over 10. We're still seeing 20, 30, and even 40 in some of these tech names. That is simply not sustainable. That's not just my opinion. That's what history tells us. Hundreds of years of market histories that, 10 times sales is a temporary condition at best. You better have some dynamic, several 100% growth or your stock is going to crash. Pretty much guaranteed to happen. Now, the other problem here is, I keep hearing people talk about, well, inflation's not going to be as bad as they're telling us. They'll be able to moderate conditions soon. You know what? I hope I'm wrong and they're right, but I don't really think so. Today we saw an inflation rating again, a little bit less than last month, still over 8%, still flirting with 40-year highs. The release from the strategic reserve worked a little bit to keep energy prices down, but we saw a 20% jump overnight in gas prices here in Southwest Florida. It's not going away, and there is a potentially much larger problem on the horizon. If you drive a diesel vehicle or a diesel truck, you know what I'm talking about. Diesel prices are well over $6. They're out of control. They're going higher. There is a massive diesel shortage, not just in the United States, but all over the world. Here in the States, we may have to restrict diesel exports. It's a refining problem, guys. First off, northeastern United States, it's getting really hard to even find diesel, according to some of the folks I've talked to, some of the articles I've read. There's simply no diesel to be had. There's only 7 refineries on the East Coast, guys. As refineries have closed down over the last several decades, there's been a not in my backyard attitude. No more refineries have been built. We've relied on other locations, Canadian, the Gulf Coast region. Well, guess what? Most Canadians, when the oil and gas prices got to a point where the oil sands oil didn't make a lot of sense, a lot of Canadian refineries closed. We killed off the Keystone Pipeline, which meant a lot of that heavy crude that could have gone towards diesel that was going to be pumped down to the Gulf Coast region. Well, guess what? It's not even coming out of the ground now because there's no effective way to transport it. The other place that we were looking for the mid to heavy grade of crude oil to produce diesel and jet fuel, that's right, Russia and Ukraine. Guess where we're not getting any oil right now? Russia and Ukraine. So there is a looming diesel crisis. No real near-term solution in sight. The expansion of travel is making it worse, guys, because jet fuel and diesel, well, they're basically the same. They come from the same feedstock. Now, why is this important? You need to think about this a minute, guys. There is not one single item. You go in your grocery store, you go in your drugstore, you go to Home Depot, I don't care, pick a store. Go in there. You go in there and point to all the items in that store that did not have diesel involved in that getting from the warehouse, from the production facility to the warehouse to you. There's nothing in there unless it was built locally, okay, or sourced locally and delivered by a gasoline truck. Not too much of that. Almost everything we buy involves the use of diesel fuel. If the price of diesel goes up, guess what? So is the price of everything that we buy. You think inflation's been bad? Let this diesel crisis spiral out of control, and it gets even worse. Purely a result of bad policy, guys. Very poor decisions based on refineries, pipelines, and some other decisions. But this is going to show up in food too. Why? Not just the shipping. Okay, what do you think the farm machinery runs on? The big tractors and all the other machinery. I don't know the names of the machines. I'm a city kid. But they all use diesel fuel. So that's going to lead to extra increases potentially in food prices. I'm watching this very closely. It's something that Garrett Baldwin and I, my son-in-law, we bore the hell out of my wife and daughter when we all get together because it's one of the many things that we like to talk about, along with Orioles baseball. And I think the wives would prefer we talked about diesel fuel. But anyway, this could be a crisis. And it's like 3 decades of bad energy policy, of hoping we could get to renewable long before we can, of not wanting to have refineries or pipelines in our backyards. Which I guess is an understandable sentiment to some degree. There's a price tag to that, and we're seeing it. If we don't figure out how to get a lot more diesel and jet fuel refined in the United States, this is simply going to get worse. The catch-22 in that is every gallon we take away from gasoline production to put into diesel or jet fuel production reduces the gasoline supply, and then maybe we have a gasoline problem. So energy policy has led us to a place where some very difficult decisions are going to have to be made. The biggest decision that must be made is we must go all the way back to Mitt Romney's presidency for the candidacy for the president of the United States and drill, baby, drill. We need a lot more oil to market, and we need it right now, or inflation is going to get even worse than it already is. We haven't, fixed the existing supply chain problems. Wage inflation is cropping up. Lots of problems coming from all directions. No cure for what I see going on in the markets. By the way, the leading indicators that I favor are telling me the same things. When I look at interest rate relationships, when I look at high yield credit spreads, they're all saying, nope, not yet, not even close to over. Don't get me wrong. There's going to be some rip your face off snapback rallies in here, and we're going to grab them as we can when the credit spreads and interest rate relationships tell us, hey, here's a short-term opportunity. You're also going to see the 200-day moving average is also screaming no, no, no. But you may see some severe oversold conditions in the market that I'll rely on some of my more technical friends to tell me about in advance that may give us snapback rally opportunities. But stock market returns are probably going to be bad for an extended period of time. I mean, 5 years and longer. I've been talking about this for a long time now, and it hasn't gotten any better. From these valuations and where interest rates started, it's just a story of low returns ahead. So what do we do? I mean, it's a real problem, right? Okay, we got to look at a couple things. When I look around right now, because of all the volatility in the financial markets, there's a lot of crazy stuff going on, a lot of busted deals, a lot of special situations. And I've been digging around looking for some to bring to you guys to share them with you so you can get some idea of what you might be able to get from some of our paid products as we go along down the road. Now, so what are we looking at right now? We'll have Kohl's, KSS. Here's a great example of a special situation. This is a board that is so totally negligent that I'm shocked that the activists did not win this fight. The board won. None of the activist investors were awarded board seats this week. Probably didn't help that it was a fairly unknown activist. I think if that'd been Bill Ackman at Pershing Square or Starboard Capital or one of those, we might have had a different outcome. There's 4 offers on the table as I count it. They're all $60 or over for the company. The stock's currently at just $47 a share. The board is in place, and the question now has to become, we're going into a period of time where there's a good chance that we have inflation, Fed actions of raising rates continually between now and next year tip us over into recession. So we go from a period of high inflation where it's difficult for consumers to spend cash because prices are rising so fast, to a period where consumers don't want to spend cash because they need to conserve it because we have an economic recession and jobs are being lost. That's brutal for retail. Right now, retail sales are up. Consumers are still, they're been more resilient than you might have expected with all the weirdness going on. We're still seeing reasonable consumer sales. Kohl's stock at first glance looks cheap. The question is, can management do the things that they have to do? They've got to get this stock back up over where the offers from the activists and strategic buyers have been over the last couple months, or they're all going to lose their board seats and be really lucky not to be sued for gross negligence. Right now, stock's like $17, $18 behind what I thought was the best offer for the company. So how much lower can the stock go? That's a question with no answer. However, I will tell you that you can buy the stock here, just continually sell, 2 to 3 month calls to continually reduce your cost and bring in premium income. Eventually, this thing either gets sold or management really executes and growth accelerates and the stock moves higher. One of the two things I think is going to happen here, regardless of what the market does. You can go out to June and sell a cash secured put for a monthly premium on return of about 6% on the $4,700 that you'd have to put up. That's it's 2 months out, so you're looking at about a 72% annualized return if you can continually do that. As long as the stock is in play, you should be able to continually do that. So you can either sell calls and just be a premium collection machine, or you can make some smart put sales and eventually back into the stock at a much lower price. Pretty much the same situation, guys, at Sportsman's Warehouse, SPWH. Now, the parent company of Bass Pro Shops had come to them with an offer of about $18 a share. Sportsman's, which is primarily in the western part of the United States, accepted the deal. They were pretty excited about it. And then the rumors came out that, hey, you know what? Because, Bass Pro Shops is everywhere. They're in all the big malls and strip malls and just all over the country. They're a pretty easy store to find. They decided that, that maybe there was some conflict of interest. There was some, competitive concerns on the behalf of the DOJ. So the deal was pulled and the risk arbs immediately bailed because this had looked like a lockup. Got pretty heavily owned by risk arbitrage players. So the stock has gotten hammered. I first suggested, hey, let's look at this at 12. Well, now it's 9 and small change. All right. The stock is trading at less than 5 times earnings. I think you can just buy it right here and hang on to it because I think eventually, remember, these guys are generating a ton of cash just on regular business, hunting, fishing, handguns, ammunition, soccer, football, basketball, outdoor sports, indoor sports, everything. Okay. Smaller version of a Bass Pro Shops concentrated in the Western United States for the most part. They're doing great. Eventually, especially if the Democrats retain some measure of control in the midterm elections, going into the second half of what will then possibly be a lame duck presidency, you're going to see a gun control bill. And it's going to come up and it will accelerate gun sales because remember, Democratic presidents are the best gun salesmen in the history of the world, with the all-time champion being Barack Obama so far. Mr. Biden could easily surpass that if he pushes hard for gun control. So there's extra profit sources. I'm not the only one out there that knows that. If a private equity firm decides they want to buy Sportsman's Warehouse for $18 a share or more, because I certainly don't think management would take less than they already had on the table since profits are pretty much the same. So I think you can just buy the stock here. Good chance private equity comes in and snaps this up, or just the market recognizes that, hey, 5 times earnings is way too low a price earnings ratio for a company that is growing the way this one is. Or again, you could turn into an options collection machine. Let me just check my numbers here. You could just buy the stock, continually sell covered calls, or you can go out. That's about the next 2 months. Sell some puts on that for about $1.30 in total collection over the next year. It'd be an annualized profit of 6%, of 86%. So, there's opportunities there, guys. You can make a lot of money selling the every 2 month calls. You can make a ton of money selling the puts that set up a very high rate of return. Even if not called on the covered calls, you get about 4% annualized. Personally, I'm more in favor of just buying the stock and maybe doing some covered calls against it rather than selling the puts. That's just how that one's set up. For those of you that like short squeezes, and I'm going to let you do the options homework on this one yourself because I think you can just buy the stock here. Camping World Holdings, the big RV company, just reported record all-time revenues and profits. They have one of the best CEOs in the business in Marcus Leonis. In the quarter, they bought back about 2.6 million shares, still have $120 million left to spend on the current buyback. Since I've been kind of following the stock since the great financial crisis, being aware of what's going on there, when it traded around under $10 a share. If history holds true, when this buyback is used up, they'll authorize another one and continue to buy back stock. This best quarter ever, 6.7% cash dividend, active stock buyback, and a whopping 41% of the shares are sold short. right now. This is a massive opportunity. I get the whole gas prices are so high and nobody's going to spend. But remember something, 80% of us are in pretty good shape financially, guys, even with the inflationary pressures. A lot of people during the initial stages of the COVID took early retirement and are out now. They've retired. They've got the time and the cash, thanks to the rising markets and rising real estate, to buy a mobile home and do some traveling around the country. We recently hosted some younger friends of ours who have a couple of kids going to late elementary school and first year of middle school, if I recall correctly, younger kids, but they're homeschooling them and traveling around this company in the RV. We had a great visit with them, but we're seeing more and more of this. We've got another friend who spent the entire pandemic in an RV, traveling around the country for about 2 years. RVs are still in demand. It's not going away. Camping World is one of the biggest players. They've grown by acquisition. If we see weakness in the space, they'll make more acquisitions. They're pretty well capitalized. Their stock price is decent currency at this price. So we could easily see a major short squeeze. The stock is at 27. Volatility is pretty reasonable. Like I said, I'll let you construct your own option strategy. And again, you can sell puts to back into the stock or sell covered calls to become a premium collection machine, thanks to the rising VIX levels. So that's just special situations. They're everywhere. That's only 3. There are a lot more. I didn't cover a lot of categories here today. We really didn't even get into 13D and activists or SPAC orphans or some of the other areas that I can get really excited about no matter what the market does. Now, real quick, we're going to run into, because I did bring you what I think is a great high yield bank corp. Washington Trust Bank, symbol is WASH. They have 22 branches in my cousin's home state of Rhode Island. They've got 1 branch in Connecticut, about $5.8 billion in assets. Not a huge bank, but could be a very attractive takeover candidate under the right circumstances. And this bank has also done some acquiring in its time. 41% single family home loans, about 32% commercial real estate, and right around 10% multifamily lending. They're really good at this, guys. Non-performing assets are just 0.22%. That's impressive enough. But if you go back, Piper Sandler just put out a list of best banks during the great financial crisis, and they used 2008 to 2012, which for banks were pretty much the worst of times. Washington Trust, when you went back, according to the Piper Sandler analysts, and again, I consider them some of the very best in the business, right up there with my friends at Janney Montgomery Scott, they had total non-performing assets of 1.47% at the peak. Those were very quickly cured, as less than 1% of all loans on the books cumulatively from 2008 to 2012 were actually charged off. They were never threatened in any way, shape, or form. They're very conservative bankers who are very skilled at evaluating loans. It's a culture, guys. They've been doing this since 1800. They've been through so many different crises. The Civil War, the War of 1812, World Wars I and II, Korea, Vietnam, the Great Depression, the Great Recession. Pick one. The Cold War. They've survived all of it. They're still here. They're not the world's biggest bank, but they never wanted to be. Very conservative, very profitable, trading at just 11 times earnings with a 4.7% dividend, 4.67% dividend right now, just 11 times earnings, lots of upside. Banks are in tremendous financial condition. They should not be selling off the way they have been. When the market does finally turn, banks are going to lead the way higher. And I think they're probably just about done going down. It's the one sector I'll point out and say, yep, nope, gone too far, needs to at least stop here. So we can collect some fat dividends. When the rallies come, this stock is going to leap a lot higher. Anyway, ran a little longer than I meant to, but hey, I've got 2 days there that I didn't get to say much of anything, so you got it all at one time. Special situations, small banks, low PEs, with great dividends. And again, looking at closed-end funds that are going to benefit from inflation. And we're also still looking at bank takeover candidates and buying when and where we can. Guys, I'm Tim Melvin. Hopefully, I'll be back to you Friday or over the weekend, but if not, Monday at the latest. Enjoy the rest of the week. Thanks for listening.